Welcome back to The Explainer. You ever get that feeling that you're just a step behind in the market? Well, today we are pulling back the curtain on the psychological games that drive stocks. We're going to explore why we follow the herd, who the real whales are, and most importantly, how you, as an investor, right here in our community, can use this knowledge to stop following and really start thinking for yourself. Let's get into it.
So let's start with a really simple thought experiment. Just picture this. You're hungry, you're in a city you don't know, and you see two restaurants. One is packed with people, and the other one is totally empty. Where do you go? Come on, be honest. Most of us, without even thinking, would head straight for the busy one. It's just a gut feeling, right? But that gut feeling, it actually reveals this powerful, hardwired instinct that affects a lot more than just your dinner plans.
That instinct? It's called herd mentality. We see a crowd, and we just automatically assume they know something we don't. It's a mental shortcut. And, while it might lead you to a decent meal, that exact same shortcut can lead you right off a cliff when you're investing your hard-earned money.
To really get a handle on this, we've got to understand the battle that's happening inside our own minds every single time we look at the market. It's this constant conflict between rational thought and a really deep-seated instinct.
In the world of behavioral finance, this isn't just a hunch, it's a well-documented cognitive bias. It's that little voice in your head that screams, "Hey, buy that stock, everyone is talking about it," or "Sell now, everyone is panicking." It's what happens when we let the crowd's emotions just completely override our own research.
And this quote just brilliantly illustrates how deep this instinct runs. Going against the herd isn't just mentally tough, it can feel physically painful. Seriously, it triggers this primal fear of being wrong, of being left out of the group. So next time you feel that knot in your stomach about selling a stock everyone else loves or buying one they all hate, that's not just you. That's your brain hardwired to stick with the tribe.
Okay, so that's the internal battle, but it gets even more complicated when you look at the external battlefield. It's not just about what's going on in your head, it's about who you're up against. In the vast ocean of the market, you've basically got two kinds of players, the tiny plankton and the massive whales.
First, let's talk about us, the plankton. That's all of us individual retail investors, like so many of you in our community. What's absolutely fascinating is that now our collective behavior is totally measurable. Researchers found that when a stock suddenly gets a huge spike in Google searches, they call it the abnormal search volume index, it's a really strong predictor that the retail herd is about to make a big move. Our curiosity literally becomes a data point.
And here's the really crucial pattern that all this data reveals. In a bull market, when everyone's feeling optimistic, the herd just stampedes into small cap stocks, the smaller, high-risk, high-reward companies. But when the market turns bearish, what happens? The herd panics and sells off their large cap stocks, the big, stable, blue chip companies. It's this super predictable cycle of chasing hype and then fleeing in fear.
Now, on the complete other side of this ecosystem, you have the whales. These are the institutional investors, and their scale is almost impossible to wrap your head around. These big players come in two main flavors. You've got foreign institutional investors, or FIIs, bringing in capital from outside the country, and then you have domestic institutional investors, or DIIs, from within the country. We're talking about gigantic pension funds, insurance companies, global banks. These guys don't just ride the waves of the market, they create the waves.
To even begin to understand the world these whales operate in, let's just look at the kind of money they manage. It all starts with what are called high net worth individuals, who are typically defined as having at least $1 million in liquid assets.
And there are a lot of them. We're talking over 21 million of them worldwide. This is basically the foundation of capital that these giant investment firms are built on.
And when you add it all up, the total wealth of this group is a staggering $90.5 trillion. That is the ocean the whales are swimming in. It's a scale of capital that's almost impossible to even comprehend.
So yeah, all this massive capital, it gives them a completely different playbook. While we're over here Googling stock tickers, they're using these incredibly sophisticated Bloomberg terminals. While we might be chasing short-term trends, they are very often playing the long game. And they get access to exclusive deals that most of us will never even hear about. I'm talking private equity, venture capital, and getting into IPOs before they even hit the public market. It's a whole different ballgame.
Okay, so we've got the battle in our minds, and we've got the battle in the market. The big question I always get from our community is, how do we, the plankton, survive out there with these whales? Well, the answer isn't to try and be a whale. It's to be a smarter, more agile fish.
First things first, let's look at the traps. A huge mistake is chasing the FIIs, because by the time you see their move reported, the real money has already been made. Another is totally ignoring the DIIs, who are often a steadying hand in the market. But maybe the biggest trap of all is thinking your job is to perfectly copy everything they do. It's not.
Instead, here is a simple 4-step playbook. Number 1, gauge the sentiment. Think of FII and DII activity as a weather report, not as your marching orders. 2, watch the locals. Pay attention to the long-term trends of DIIs. They often signal real conviction in the domestic market. 3, and this one is by far the most important, do your own homework. Use their moves as a clue, not a command. You have to combine it with your own fundamental research on a company. And finally, 4, stay disciplined. Build a plan that actually fits your goals and then stick to it. That is your ultimate shield against the herd.
So at the end of the day, it really all comes down to this. Understanding the market psychology doesn't give you a crystal ball, but it does give you something much better, a choice. You can choose to follow the noise of the herd, or you can use this knowledge to find your own path to value. The choice is yours. Thanks for watching.